Hey guys, Crypto Karen's here with another groundbreaking video on how you can get rich on cryptocurrency. That's right, in this video, I will teach you how to turn $1,000 into $1 million. That's right, $1,000 into $1 million. All you have to do is send $1,000 to my Bitcoin address below, and I will create a custom module for you that tells you 5 easy steps for how to do this. Do you want free money? Do you want to be as rich as this baby in this picture here? Do you want to be rich as me? Well, then send $1,000 to my Bitcoin address below, and I'll tell you exactly how to do just that. Trust me. If you see a video like that from someone else, run to the hills. Bitcoin price predictions of $1 million by 2025, scams, charts that make no sense, investing in some unknown cryptocurrency that earns 5,000 APY. There's so much bad information out there on the internet for cryptocurrency that is trying to hook you in for your desire to get rich quickly and your FOMO of seeing other people who have been successful in cryptocurrency and wanting to match them. Do not fall for this psychology if you're somebody who's new to the space. If you're not new to the space, or if you are, I want to present my strategy for how I manage my cryptocurrency, how I think about cryptocurrency using portfolio diversification techniques that I learned from trading stocks in the stock market and managing my own stock portfolio. I want to reframe how people look at crypto and see it as a long-term risky investment than it is for something to get rich quick. So this video is going to show some techniques that I use, some coins that I own, and hopefully help expand your way of thinking about cryptocurrency to make intelligent decisions on your own when you do your own research. So before I explain how I chose to compose my crypto portfolio, I thought you might be curious which coins that I chose to compose my portfolio. I'm not going to break down why I own the particular coins in this video. That'll probably be in the next video or a future video. 45% of my portfolio is in Bitcoin. 25% of my portfolio I consider altcoins, which is a bunch of different smaller market cap cryptocurrencies. 20% of my portfolio is in Ethereum. 10% are in stablecoins, UST, USDC, and USDT. My altcoin portfolio is 35% Jewel DeFi Kingdoms, 25% Luna, which is the Terra ecosystem, 20% is in AVAX, Avalanche, and 10% is in Near. Those are all layer 1 Ethereum virtual machine type coins, which you might want to do the research if you don't know what that means. And 10% is in a project called ICE, or Popsicle is the name of the project, and Danny Tiesta is a trending developer that has a lot of innovative, ambitious insights that I am betting on. So before I get into this theory, I want to address people who might not have much experience with crypto or finance in general and are considering buying in and thinking about how you want to make money. So if you have no time at all, it's probably not a good idea to buy a bunch of coins that are not Bitcoin and ETH, because managing them and following the news will probably be too difficult to do. Time sensitivity matters. So if that were the case, but you're still bullish on crypto, what I would do, I would probably buy Bitcoin and ETH and hold about 75% in Bitcoin, 25% in ETH, and I wouldn't put too much of my net worth into it. I think proportionately, the more time I'm willing to spend in anything, the higher percentage of my net worth I'm willing to put into it, assuming it has some sort of financial gain. If you are interested in getting into this, look up DeFi, DEFI, decentralized finance, Google it, and check it out on YouTube, because if you're planning to hold a diversified basket of cryptocurrencies, it makes no sense not to do it without getting a high yield on those cryptocurrencies. It's a little more challenging and time intensive, but it is easily worth the payoff, in my opinion. Now that we got that out of the way for the news, we can get into the gritty, the nitty, the portfolio theory. So a few things, few concepts port over from stock portfolio theory to crypto portfolio theory. That is, it is very important that you manage your risk within the portfolio by having a higher percentage of your portfolio being composed of lower risk assets than higher risk assets. In cryptocurrency, the vast majority of coins are very high risk assets that more likely than not will go to zero in over the course of the next 10 years. There's only two big large market cap assets that have proven themselves and have potentially passed an event horizon of being some sort of long-term asset, and that is Bitcoin and Ethereum. So it is important that you compose a high percentage of your portfolio in Bitcoin and Ethereum if you want to reduce the probability of going completely broke with your crypto portfolio. It also will mute the intensity of the swings, which everyone likes to think of themselves as being more emotionally strong than they are. But once you lose 90% of your crypto portfolio in a day or 2 days, you will very quickly reassess that if you have any sort of significant amount of money in it. So the riskier and lower the market cap of a coin, the less I'll invest. The riskier and or higher, sorry, the less risky and or higher the market cap, the more I'll invest. So that applies also to stocks. If I was composing a stock portfolio of some tried and true S&P 500s and some junk stocks here and there, local companies, etc. The exception to this low risk mentality is if I have a lot of conviction in a particular project. So the more research I have, the more insight I have into a project relative to the market, the more I'm willing to risk, but still only up until a point, because all of this stuff is quite speculative and there's very little way that anybody can tell the future in a few years. So I might willing to put 3 times more in a project that I really know all sorts of intimate details about than a project that I wouldn't. But I wouldn't compose my crypto portfolio 80% of one particular project unless I would have to be mentally ill levels of conviction and reason. Another thing I learned from managing my own crypto portfolio that also is similar to stocks is to not spread myself too thin. The better investments I make are when I understand something about a project unique that most of the market does not understand because I've spent the time and research. If I narrow my focus to 10 coins, 20 coins, something in that ballpark, and then only invest in about 5, I am able to get those insights. I don't have the time to do that for 100 different projects. You're not properly diversifying yourself if you're making bad bets on correlated projects. The project that I've done the best on, which is DeFi Kingdoms, the reason I invested a decent amount of money was I was following it extremely closely and I saw all these good green flags throughout the development that I thought would be a good investment. So I ended up tripling down and then doubling down later. I wouldn't have been able to do that if I was lightly looking and blindly throwing money at different coins. So generally, there's a trade-off between specializing and diversifying when it comes to putting all your eggs in one basket. But so you want to diversify a little bit, but you also want to be able to specialize enough that you're able to get insights relative to the market. So that's the fine line I would cross. The next concept is correlation. In portfolio theory for stocks, you want your stocks in your basket of stocks to not move in step. So when one stock goes down, that doesn't mean for sure, or it's even likely, that another stock will go down. And the reality in cryptocurrency is that the vast majority of coins are deeply correlated during drawdown, which means a large drop in price. However, I believe in the future that will shift a bit. And I'm looking for diversification in narratives. What I mean by that is I'm looking for catchy, sticky, viral properties that certain types of cryptocurrencies will have that is different than the mainstream Bitcoin. So, for example, GameFi is a narrative, oh, cryptocurrency video games. I want to invest in a video game. And I think cryptocurrency has some interesting implications in conjunction with video games. So even if I think Bitcoin as a store of value won't do well, but video games with their own form of decentralized tokenomics that can't be regulated, I think that can do well. So I could foresee certain scenarios where things start to uncouple. Important element of risk management in stocks and in crypto has to do with portfolio rebalancing. But what portfolio rebalancing means for stocks is quite a bit different than what it means for crypto. They're both an element of risk management, but for stocks, there's a much more mathematically precise, computer-based, calculated strategy that relies on 100 years of data. It relies on asset classes like emerging markets to have a very similar proportion in value from the past 10 years to the next 10 years. And relative to other classes, all of a sudden, emerging markets won't be completely useless, things like that. There's also a trend of mean reversion, which means asset classes will go back to the average percentage when it outperforms or when it underperforms. So the natural conclusion of that is to sell your overperformers and buy your underperformers at the end of the year. And a lot of people apply that to cryptocurrency incorrectly. The big danger with applying that to cryptocurrency is that it's assuming that its number is going to go up indefinitely. And for particular crypto coins, that is not true. In fact, the vast majority of them will go to zero. So if you're buying the underperformers consistently, you're going to buy all these projects that are going to go to zero. Also, if you're selling the overperformers aggressively, you are going to completely take the gas out of a coin that could go up 100x, 200x. If you're selling 50% of your Bitcoin every time it goes up 2x, you're going to have almost no Bitcoin at the start, and you're not going to be able to realize the exponential gains. So, but you still want to be able to sell when one coin does really well, and you want to be able to not hold those coins that do really well for a while, but then the market changes, the world changes, and then no longer have a use, and that doesn't go to zero. So you're navigating all these things. So I still like to port that's the stock portfolio management theory over to crypto, but I like to do it much more delicately. When a crypto coin goes up 3 times, it's an altcoin, and it is now dominating my portfolio. So I still see it as a high risk venture. I haven't learned anything more about it other than people like it a little bit more. I now want to sell a little bit to still be able to capture its further gains if it decides to go, but I also ensure that I make a profit and I end up still keeping my portfolio with like my high risk projects being a low percentage of my portfolio and my low risk projects being a high percentage of my portfolio. If a project goes up a lot, I might do some research as to why. Maybe my thesis as to why it is high risk has now changed and it is a lower risk project than it once was, in which case I'm happy with it composing a higher percentage of my portfolio, but I will not blindly rebalance. So skim at the top. So that's how I think about managing my portfolio. But that's the how. What about the when? The when can be as important as the how. However, market timing is extremely difficult, and anyone who tells you different is a liar. Most people rely on their emotions to guide them to when they sell. When they feel like buying, they buy. When they feel like selling, they sell. However, unless you are an autistic god, your emotions are probably lying to you. I feel that same exuberance, but I've trained my mind to act the opposite of my emotions. When I feel that exuberance to buy, that probably means there's a mania spreading in the market, and that means, oh, there's probably going to be a large correction coming sometime in the future after price discovery. So once I feel that, I tend to tune myself into the markets and think, okay, things are getting manic. What is overpriced? That's my mindset. And then the opposite will be true if there's a lot of Bitcoin liquidations, if things are going down a lot, if everyone's posting McDonald's memes, McDonald's Pepe memes on Twitter. That's when I'm going to think, okay, things are scary. Bitcoin actually might be a Ponzi, but there's probably some discounts in the market. Do I believe in crypto? Yes, I do. This is the reason I'm in it. And I'm going to try to act the opposite of how I feel. I strongly believe that you can exploit the emotional weakness in the market and buy coins profitably in this way. So I like to time my rebalancing of my portfolio with these dips and spikes. Is this a foolproof strategy? No, but this is my opinion of how to exploit the emotions in the market without actively trading too much. I'm rebalancing things that I want to rebalance anyway, and I'm using these emotional triggers as the catalyst to rebalance. Stable coins are a bit different. Stable coins are an important part of a diversified portfolio. However, I don't think they're quite as lucrative as they might otherwise appear. The risk of default of stable coins are non-negligible. If cryptocurrency completely explodes, it is unlikely that many of these stablecoins will maintain the US dollar peg. USDC probably will, but it is running to its own risk of regulation, whereas USDT has a lot of allegations of corruption that might get exposed if things hit the fan. UST and MIM have proven themselves to work under scary fluctuations, but not catastrophic situations yet. And that 15 to 25%, I'm not sure if it makes up for all that, the default risk, considering that when things go okay, slightly bad, and very well, that there's Bitcoin and Ethereum will likely make a much higher return than 15 to 25%. Again, if these did well, if Bitcoin and Ethereum went to zero, which might happen 20% of the time in all future simulations, then it would be an incredible bet. But I don't believe that is true. So I use it as a means to market time. When I think the crypto market is overheated and I'm trying to take some profits, I will transfer those winnings to my stable coins for when the market cools down and it looks like people are afraid, and then I will buy other coins with those stable coins. If I were to offload my winnings to fiat, I would incur 2% fees each way withdrawing money, and it would take a bunch of time, so it's not really practical to do so. So I don't see them as critical to balance your portfolio. If you're trying to lower your risk, I would probably just have less cryptocurrency than I would to invest in stablecoins. So they're useful, but I think they're more risky than the numbers present. So in summary, I see crypto as a means to generate wealth over a longer period of time in magnitudes that are greater than the stock market, but are not turning $1,000 into $1 million, like I so hilariously put at the start of the video. I'm not trying to get rich quick, I'm just trying to get rich. So I could see there is alternative routes in cryptocurrency that are a lot more long shot betting. If you want to gamble, if you'd rather figure out how to identify the good projects from the shaft amongst new emerging projects, and you think you might be good at that. Some people have made silly amount of money doing so as successfully and consistently, and are able to also get a social media presence to shill those projects. Then they buy them when nobody is into them, and then they go up big, and then they sell them. That requires a lot of time, full time, and requires a lot of skill. More people will lose money than will make money who will try to do this. But if you want to go down that angle, I think that there is some money to still be made in that area. It's out of my scope, not what I'm good at. I'm better at assessing the fundamentals of a project than I am how people will react to a project. It's a different kind of thinking. Follow me at Heisenberg on Twitter. Like and smash that subscribe button. Tomahawk, chop that shit if you want to see more. It's my second video, so hopefully you enjoyed it.